Have you ever wondered why the markets become all jittery, all freaked out, man, when economic indicators like the PPI and the CPI are about to be released? Of course, I don't think it's because as investors or economists, everyone's just sitting around and is so excited to see Fed Chairman Jerome Powell come out. And we all overanalyze what he says down to the last little tiny detail. No. Look, these economic indicators have long been used as gauges on how the general economy is actually doing. Just like car gauges, it'll actually tell us if the economy is overheating or about to run out of fuel. Brake lights on, guys. So let's take a closer look at some of the key numbers that were announced recently, what they actually mean, and stay with me until the end of the course to learn if we should be worried about all this or not. Now, the first indicator is the PPI, or the Producer Price Index. Now, before we look at the numbers, let us first discuss what PPI actually is. See, this is a measure of the average change over time in the prices received by domestic producers for their output. In simpler terms, it tracks how much manufacturers and suppliers are actually charging for their goods, not what consumers are paying in stores, okay? Key difference. Now, this is the reason why it's not as popular as the CPI or the Consumer Price Index, because consumers, they don't really want to know the price of the production of something, but rather how much they actually need to go and pay for that thing at the store. Nevertheless, it is still a very important measure of inflation, since the price from the source often then precedes changes in the end consumer prices. Surprise, right? Now, as for the numbers, the PPI increased 0.5% in April and was up 2.2% on a 12-month basis, the biggest gain in a year. Interesting. The increase is also higher than the 0.3% Dow Jones estimate. Typically, changes in PPI can be an early indicator of what might happen with CPI, consumer inflation. If producers are essentially paying more for their inputs, they're likely to pass those costs on to you, the consumer, leading, of course, to an increase in CPI. And speaking of CPI, this metric was also released recently. So on May 15th, we got that number just a day behind the PPI. Now, that story is pretty much the same. The report shows an increase of 0.3% from March. FYI, when these data points are released, they are pertaining to the previous month. For example, the data released in May was for April, and the data released in June will be for May. Okay, so the increases and decreases we see are then compared to March. In this case, the data is released by the Bureau of Labor Statistics. Now, going back to the CPI numbers, the 0.3% increase is also below the Dow Jones estimate of 0.4%. Now, this is also lower when compared to the 0.4% increase from the previous month. Okay, so on a 12-month basis, the CPI increased 3.4%, which is in line with expectations, even though there was an increase. This is still much better than expected. So, of course, the market reacted in a positive way. Hence, the market pump that we saw recently. Now, according to Dan North, who is a senior economist over at Allianz Trade North America, this is the first print in a month that wasn't hotter than expected. So there's a relief rally. He also said that the excitement is perhaps a little bit overdone, and yeah, maybe people are getting a bit too excited about that, and we'll get to that later. Now, the third economic gauge is the retail sales report, because of course you keep hearing, well, the consumers getting their butts handed to them, everything's terrible. This is compiled by the U.S. Census Bureau. It is a critical economic indicator, essentially, that reflects the sales from 13 14 major types of retailers, from food and beverage to gas stations and beyond. The latest report for April 2024 shows retail sales at $705.2 billion, which is virtually unchanged, indicating actually stability in consumer spending, as the figure remains pretty damn consistent with the previous month's data. So consumers are still spending just fine. There hasn't been some apocalyptic cliff jump here. This stability suggests consumers are maintaining their purchasing habits, which of course is a positive sign for your dog coins. I mean, the economy, of course, guys, obviously. Now, there's a fourth lesser known indicator here. It was also released recently, and that's the Philly Fed Manufacturing Index. Now, might seem overly regional. Philadelphia, let's go. But it does pack a national punch. See, unlike the CPI and the PPI, which are in reality lagging indicators, this index actually looks ahead. By surveying manufacturers about their activity, it provides clues about future inflation and future economic trends. The May index dropped to 4.5 from 15.5 in April, which is a big drop, but is actually still good. You see, any score above 0 means that manufacturing is still expanding. Although there was a contraction, we're still in the expansion zone overall. Anything below 0 means that it's in a contraction phase. So a bit of a slowdown, but still positive. But the devil's in the details, as always. More companies reported a decrease in activity this month, which is 25% compared to 22% last month. The percentage of firms that are experiencing increases in activity also fell, down to 29% from 38%. Overall, the data suggests that there is a slowdown happening, though not as bad as expected. It remains to be seen, of course, if this is all a precursor to a broader economic apocalypse, recession, Great Depression, all the scary words, right? However, something called the Sandler Piper rule has also just flashed a recession warning. Now, this indicator, very interestingly, has been right every time since the 1940s, which, of course, doesn't mean it will 100% be right this time, because it has been wrong before. It's just been a long time since it's been wrong. So perhaps it's worth paying attention to, though, keeping in mind that nothing is right 100% of the time. Look, the real economy is still struggling. The consumer is struggling. Credit card debt massively high. Savings are very low. High rates are crushing everything in the economy. It's the economic steamroller right now, essentially crushing the American economy. These high rates cannot keep on forever. The Fed will need to pivot soon or face disaster. And yes, the money printing is here. I know the money printing is here. They're doing it. They're irresponsible maniacs. The Fed's dumping $2 billion a week into bond buybacks right now, as well as the other phantom printing going on. It has been going on for a while, like the bank bailout program that was quietly put in place last year. Not a lot of fuss was made about it, but that was a lot of money put on the line. Probably all a little too late, though, for the Fed. Higher for longer interest rates are an economic wrecking ball. They're not a delicate tool. And for regular people, the pain is here. Mortgage rates and stuff like that, crazy right now. So to summarize, both the PPI and the CPI have increased, but very slightly. Retail sales haven't dropped. That's good. The manufacturing sector still expanding, although seeing a bit of a slowdown. So the numbers, good or bad? Well, it depends on how you look at it, of course. Inflation is still here. Inflation is still too high for the Fed. And if you ask the average consumer, they're still struggling. It's a bad thing, okay? Wages are not keeping up. But it also means that the economy is not contracting, which is obviously a good thing. It means there's no recession yet on the horizon. And inflation in itself isn't inherently good or bad. It's the rate and stability of inflation that really matters most for economic health. A 3% inflation rate can be fine, as long as it's not going 3%, 6%, 9% in months. The Fed target of 2%, which they consider as the sweet spot, we're a bit over that, but, the Fed might be happy enough in this range. Anything much higher than this, though, gets to be a bit crazy. So the Fed, of course, will continue to use tools at its disposal to try to hammer that down, trying to get back to their sweet spot of 2%. And one of those tools, of course, is high interest rates, which are unfortunately at this stage still high. Higher for longer is here. Rate cuts are not in sight yet. But does all of this mean that the sky is falling? A huge bear market's around the corner and everything's going to zero? Probably not. The market cycle likely has one big bang left in it before we see the next bear market. How long that takes to play out remains to be seen. Could be over months or 18 months or 2 years. But markets will probably push way, way higher before any kind of economic disaster plays out. The next recession to come could be a really bad one. But that's always the case. Markets and economies, they move in boom bust cycles because of this central bank intervention and things. We still have some boom to go before the bust comes. So just remember to take profits, because when the bad times come, they come fast, they come hard, and you either cashed out and protected yourself and your family, or you will become a victim to markets, lose it all, and suffer years of economic and financial pain because you made bad decisions. Make good decisions. The choice is yours. Thanks for watching.